Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. As we begin today's webcast, we want to remember and honor the courage and sacrifice of those who have served and continue to serve our country in times of war, conflict, and peace. We are grateful for their dedication and remember those who gave their lives for the freedoms that we enjoy today on this Remembrance Day. So in recent days, Canada's Liberal government has tabled its 2025 budget, unveiling $141 billion in new spending over the course of the next 5 years. So that's the target. Investments will target housing, infrastructure, and defense, alongside a dedicated $925 million artificial intelligence fund, a priority flagged by Prime Minister Carney. With this ambitious fiscal plan now on the table, what are the key messages catching the attention of our next guest? And how might this shape the Global Asset Allocation team's outlook on Canada's economy and markets going forward? Joining us here today to unpack and discuss all of this, including potential implications for investors, is Portfolio Manager David Tulk. Warm welcome to you, David. Good to see you on Remembrance Day.
Thank you for having me.
Yeah, delighted to have you join us here. And we'll just remind everyone that you can join us with live French audio interpretation over the course of the next half hour. And send your questions in as well for David. Let's talk about Canada. Sure. On Remembrance Day, we remember lots of different things. This country appears to be trying to go in quite a new direction with its investments in itself. A couple of broad comments on the budget and how far it's taken us in that direction, if that is the focus.
Yeah, I think that's a really great place to start. And when you think a bit about the budget, it does show a very clear shift in priorities away from government spending, more towards government investment. And I think this is a really key development as we try to reimagine our place in the world. And I think a lot of that does come, obviously, from the stresses that we're getting from our largest trading partner and next door neighbor. But it also, again, really catalyzes an opportunity for Canada to invest in itself and think about its role as a larger player in a increasingly diverse economy as well. So I think from that perspective, when we go through the budget, the focus on long-term productivity enhancing technology is really key. And the devil will always be in the details, and we need to see, obviously, the effective execution of a lot of the strategies that have been outlined in the budget. But as a starting point, this is a really positive step from our perspective. And I think it hinges into the wider narrative that we see with Canada, where we have a lot of challenges, but there is a road to a better place. Mm-hmm. And as we start to move down that road to a better place, I think it does demand us to think a little bit more about allocating into the Canadian market. And that's one of the major investment themes that we've undertaken this year, is to trim pretty sizably the underweight we had to Canadian assets to a more neutral setting today.
So just on that, what we asked you, you mentioned that I think midway through the year, that was where you were going, maybe in the summer, there was that shift, that change. A lot of money's gone back into the US, almost filling a vacuum that, as investors appeared, international and otherwise, jumped out after the tariff announcements. We're now X number of months past that, and money has gone back in. Are you rushing back in? You don't rush, but
no,
tell us a little bit about that.
We definitely tend to be very deliberative and very thoughtful in terms of the allocations that we make, especially across geographies. And when we think a little bit about what's driving investors back into the United States, I mean, it really is AI and the AI-related themes. So, if you're a fan of the Lord of the Rings, this is the investment theme that controls all other investment themes, I think. Okay. So there's a great deal of focus on AI, and we want to certainly be part of that theme as well. So the way we're approaching the United States is to use managers as building blocks who are very close to a lot of those themes and can invest accordingly. So we'll use Will Danoff, we'll use Mark Schmale, and they're bringing all of those themes into our portfolio. But from our perspective, we also want to be mindful of some of the wider risks that exist when you invest in the United States. And that very succinctly is just the value of the US dollar. And we've seen a little bit of stabilization in the US dollar. It has
stabled out a bit, yeah.
It has, but I don't think anything really has fundamentally changed in terms of the underlying drivers that we would see that do point to a longer depreciation over a longer horizon as well. So what we really want to do is we want to have that investment theme around AI reflected in our positioning, but we really do, again, want to protect Canadian investors from that currency fluctuation. So really finding ways to pivot our funds out of the US accomplishes that, largely to just, again, protect the currency side of the portfolio.
Yeah, it's so interesting to hear that, and sort of the role of currencies going forward. When we come to where Canada is right now, you mentioned challenges, living amidst the tariff announcements, realities, layoffs all over the place. How do you think the Canadian economy is managing through these huge challenges? We've got the Bank of Canada cutting away, doing sort of what they can. You were at the Bank of Canada for many years. Actually, you're writing up some of those monetary policy reports that we've been reading. They're doing everything they can. How are we holding up?
Yeah, I mean, it's a challenge. And, we've seen recent GDP reports that were, pretty negative, and that is really reflective of the world that we're existing in. And Canada, again, is a small open market economy. So trade is crucially important. And as you see challenges on the trade front, that will not surprisingly spill over into big parts of Canada's economy. But I think as you go through the renegotiations of CUSMA, hopefully we can come to a better place where at least some of the uncertainty that really is almost as dangerous as the shock itself, when firms just step back and say, I can't hire, I can't invest in this environment, I really don't know what's going to happen tomorrow. And that is, very destabilizing for an economy. So if some of that source of uncertainty is alleviated, and at least we know what the rules of trade are going forward, you can see some of that investment and that spending try to catch up to some degree. So, that as we're working through the headlines and as we look through these negotiations, we'll try to get a sense of saying, well, is that now painting a brighter road ahead? And that can, again, start to stimulate a little bit more of a bounce in not only the Canadian economy, but in Canadian markets as well. So that's something that arguably has been bad, but is maybe getting a little better.
I mean, from where you sit as an investor into the Canadian economy via all of the different types of portfolio managers that you will use within the funds, are investors coming back to Canada? There's discussion about the pension funds, which have traditionally gone ahead and invested internationally. How does it look? How does this country look as an investor to you? More money means maybe good things, begets good things?
Absolutely. I mean, it's the story that you want to invest around. And I think investors everywhere will look for the best opportunity. I talk to my colleagues who are based in the United States who are, again, managing portfolios with global benchmarks, and they see Canada as an interesting opportunity. And if you sort of extract that type of approach to other firms around the world, that's a lot of money that can come to a relatively small market like Canada. And that alone, can really try to push the market higher. And we've seen these flows come in and out of the Canadian market through time. But if you try to think of the signals that investors are keying off of, I mean, you're looking at a positive growth impulse potentially. You're looking at maybe commodity prices, and gold's a big part of that, but has done well in the background, so that's a tailwind into Canada. If you think a little bit about valuation, Canada has been historically cheap, and Canada also, I mean, has been painted with sort of a fear brush when you think of investor sentiment, as you try to think of who is most likely hurt by challenges with the United States, and Canada would rank high on that list. So as each of those things maybe gets a little bit better, again, those are things that can draw international capital into Canada, and especially if you have investors that want to shy away from a depreciating US dollar, the Canadian dollar by contrast can look a little bit more appealing. And that's, again, part of the motivation for the positioning tilts that we've taken across our funds as well.
You'll often look at interest rate differentials. Some of the other differentials that seem to be going around the so-called developed world are just the fiscal moment. So the US is kind of full to the brim. They've done their fiscal, they're just trying to get out of it at this point. If you follow the fiscal story around Europe, around Canada obviously, the taps are turning on. What else do you see there, maybe in Europe as well?
Yeah, no, in terms of just the fiscal impulse, I mean, we're seeing a fair bit of fiscal spending. And then the question is that spending justified given what's happening in the wider economy? So just, on the United States as well, now that we have the government hopefully reopening, and it's on track to provide a lot of stimulus early on next year. And again, targeting the consumer, and that I think is a very powerful source of stimulus. In Europe, and even you saw this with the budget here in Canada, there's a focus also on defense spending, on infrastructure spending, trying to really revive parts of the economy that have been left a little bit less focused on in the past. So all of that I think is really exceptionally positive. And Europe is a really interesting story from that perspective, because as you know, one of our main investment themes has been an overweight into Europe, and we want to test that theme. And that theme certainly pushed European markets higher earlier on this year as we came out of the Liberation Day tariffs. This was the galvanizing moment that markets really ran with. And then since then, it's been a little bit light on the follow through. So
AI's taken over.
Yes,
again.
exactly.
Yeah.
So AI as that one theme that has reasserted itself, that's caused flows to kind of go the other way, and there's a little bit less patience directed towards Europe in that regard. So one of the tests that we want to really do as investors is to actually see what it's like in Europe. So I just came back from a week overseas where it was one of these crazy trips, 5 countries in 5 days type of thing.
Oh gosh.
Meetings.
Where did you go?
Yeah, so we spent some time in France and Germany and Belgium and in Spain, and it was just a very good opportunity to meet with a lot of different policymakers, a lot of people that have a pretty good sense of boots on the ground in terms of what is happening within Europe. And the conclusions that we came back with really was that things are happening. There is this collective realization that the role that Europe plays in the global economy has to change. A lot of that is defense, but also a lot of that is just investing in infrastructure as well. So
energy?
Energy is a big part of that as well. So there's this big push to do that, but you also have to remind yourself it's Europe. So things happen gradually and slowly.
No rush. Yeah.
Exactly. So the sense of just doing commissions and writing, white papers. I mean, that's sort of the stage we're at. So
AI can do that now.
Exactly. Well, that's hopefully the point. But that was also a very interesting comment or observation as well. Is that the AI trade? I mean, it's really hasn't shown up in Europe to any large degree. So this is very much a U.S. phenomenon, and at some point that will spread to other markets. But it's still very early innings in Europe. But really, just getting back to the European sense of progress is that it is happening, and it's just a question of maybe the market being a little bit too impatient. So it has to just take the recognition that this will take some time, but it is constructive. And if the market is now very negative on Europe, that could maybe be a bit too far as a tactical trade. So there's a sense that you could see once more policies are announced and some of this capital finds its way out the door and actually starts to show up in the wider economy, notwithstanding all of the existing challenges. But that can help to maybe just on the margin tilt economies higher, markets higher, and sentiment higher as well.
So it's an area that you're willing to be patient with it. Is there, I mean, even with the Canadian budget, it's over a number of years, which is the way it's going to work probably in Europe as well. I mean, they are trying to put a bit of rush on it, but it's still years away, or will we see some of this pretty soon?
It'll depend on the exact policy initiative, but I mean, you've seen it already, pretty large announcements within the defense industry in particular. That's really the pointy end of the spear in terms of a lot of the spending, and the rest will happen more gradually. And some of the issues that are really tied to structural economic reform could still take, years, if not decades, to try to implement. But as an investor, when you look for positive change, you don't necessarily have to see the end result showing up in the numbers, because usually when you get to that point, it's already in the price. But the sense that you are getting this impulse moving in that direction, that can be, again, a pretty compelling investment theme that we want to certainly have reflected in the positioning we've taken in our funds.
Does spreading out the currency risk play there as well, or maybe more tilted to a euro or a pound or so on, again, with the US dollar that maybe in a longer term decline?
Yeah, so that's really, I think, the high conviction view that we continue to have reflected in the funds is really just the direction of the US dollar. And it's an interesting notion because we've traditionally relied on the US dollar as that sort of safe haven. Exactly, it's your port in a storm type of currency. But as we've seen with a number of policy announcements out of the US, that's really eroding the case for the US to be that really important currency. But at the same time, it does have a pretty strong starting advantage in the sense that it's a very deep liquid capital market. So you won't see a shift overnight away from the US dollar. But if anything, I think you end up with a much more sort of multipolar world of where people go for safe havens. So some will go into euros, some will go into Japanese yen, some will go into gold, some will go into crypto. So that, I think, nuance, is really interesting to try to look at. And as a result, it just demands us as asset allocators to be a little more geographically diversified, because when something does inevitably go wrong, you need to just have a better sense of where you need to go for safety. And we're trying to, again, parcel those allocations out across those different asset classes to give our investors the best shot of staying diversified and also avoiding the big theme of the US dollar depreciating.
When you take a look at central bank policy across the globe, there's been lots of movements. Canada got out front and just started cutting much earlier, obviously, than the Fed and others as well. But there seems to be a lot more discussion, not moving as a monolith within central banks. I wonder, dying to get your commentary on that. What it means. It's probably good, but what do you think about that?
No, there's certainly it's an environment that creates opportunities, certainly for us. And you are generally seeing interest rates around the world that are fairly close to their neutral levels, which means that you're not obviously exactly. You're not obviously need to tighten from very stimulative levels. You're not needing to loosen from really extreme levels of tightness. So it really comes down to sort of the idiosyncratic conditions in each underlying economy. And then in some central banks, there's a huge political overlay, and that's most notably the case in the U.S. when you think of the Federal Reserve. So you can make a very strong economic argument to say that the Federal Reserve should probably stop cutting at this stage. The economy generally is fairly healthy. Inflation is still a little bit elevated. So just putting on your economics hat and ignoring the politics, that's probably a pretty good place for policy to rest. And that was sort of, I think, the message from Jerome Powell at the last meeting. But then when you do inevitably have to incorporate the political overlay, there is a sense that there's a lot of pressure on the Fed to potentially cut further. And as Jerome Powell retires next year, and as we see the composition of the committee maybe becoming a little bit more politicized, you might see a policy reaction that is less driven by economics and more driven by politics. So additional cuts that may not be entirely warranted. So that
wash the currency.
Exactly, and that could certainly weaken the currency. It keeps borrowing costs low, which is sort of what the administration wants as well. It juices the economy, juices financial markets, but there's also inflationary consequences to that. So as a theme that we're also, again, reflecting in our portfolios, we still want to have protection against inflation. So the Fed, I think, is a really unique example there. And then you get to the Canadian market and think about the Bank of Canada. And yeah, I mean, they moved early, and that was entirely appropriate, just given the rate sensitivity of Canada's economy around housing. And that's a theme that I think is hopefully getting a little bit better as well. But as the Bank of Canada looks at the outlook, they I think, see policy as reasonably appropriate from where it sits now. I mean, they may need to cut further should there be more evidence of labor market weakening. But generally speaking, I think they're in a reasonably good place. And then you can move to the Bank of England, where it was a very close call. I mean, that
was really interesting. Was that last week? Yeah,
that was last week. And it was fascinating because, it basically came down to one vote as opposed to having to cut versus hold steady. And they chose to hold steady. And they do have another meeting in December, which they'll probably will cut. But it just reflects, I think, how reasonable economists can disagree when looking at the outlook, because there is a lot of countervailing factors that are influencing decisions that central banks make.
Fascinating. Are you fascinated to get more data now that the U.S. shutdown looks like it will? It looks like it's wrapping up, should be over, and therefore data.
I'm so excited for data. I cannot tell you.
It's been a desert.
I'm literally a fish when it comes to data, and data is my water. So as an economist, flying blind without data is very challenging. So I'm really excited to get the dump of data that will come as the BLS and the Census Bureau open up again.
It may be negative, we're told. I mean, this is sort of what you hear.
What do you
think about
that? We'll see. I mean, this is where something actually, we have a really good edge at Fidelity, where we have a number of sort of private data sources that we can get at through the relationships we have with companies and with other entities in the United States and elsewhere. So we've been able to try to have at least some shadow data that we can use to try to just mark where things are without actually having official corroboration from statistical agencies. And there, I mean, the message still points to us that yes, there is some normalizing in the U.S. labor market. I think we can best characterize it as a low hire but low fire type of market. So it's kind of an equilibrium. And
the data that you have and generate and have access to is telling you that already,
exactly,
even without the government data.
Absolutely, yeah. So when we think about it from purely like a cycle analysis perspective, we still are in maybe mid to late-ish cycle. It's not, there's nothing in the data that screams recession risk at this point, which is entirely encouraging. And again, once you overlay some fiscal stimulus early on next year, the U.S. is still staying in a pretty good spot. So that as a domestic theme, again, is something that we're pretty comfortable having reflected in the funds. It's just, again, the currency is the big issue we want to be mindful of.
It's so fascinating, the way you look at it, just slightly differently than, is it a bubble, isn't it a bubble? You make sure that the risk is spread. I'll come back to that. A couple of questions coming in. So this goes back to investing in Canada. Apart from resources and oil, which sectors in Canada are you finding attractive?
Right. So generally speaking, when we think about investing in Canada, we're using all of our building block managers, so all the managers you know and love across Fidelity. And here we really want to make sure we have a diversified exposure. So we want managers that skew a little bit more value. We want managers that skew a little bit more growth. We want a nice sort of all-cap representation within Canada as well. So it's really up to those individual managers to go through their research process, use all of their bottom-up signals, all of their company meetings, to try to figure out what are the best individual names they can bring into the portfolio. And then when that bubbles up to a geographic allocation, we can be comfortable with how that looks.
Mm-hmm. But ultimately, you're making decisions to put money to work for those managers to do their work.
Exactly, yeah. So we're not out there in the trenches trying to pick individual securities. What we're really trying to do is just allocating among the managers. Then we have some futures capabilities and some other overlays to try to enhance different themes. But generally speaking, we have a great active management engine behind us. So we want to make sure that those individuals just have all the capital they need to make those decisions.
We've got a tariff question coming in. This is really the revenue that's being raked in by the U.S. government and being put to work the way they want it to be. Do you see inflationary pressures to continue if the U.S. administration follows through on the recent tariff revenue announcements? How are you positioning in response to this? I mean, there's just so many tariff revenue announcements right there, but
No, I think that's a really interesting story because that actually hinges into the case that's currently in front of the Supreme Court in the United States, whether the IEEPA tariffs are constitutional or not. And if those prove not to be constitutional, then that's going to create this huge bureaucratic issue of offering refunds and everything else. That's just a mess.
It's like a proper rebate system they're going to have to get going.
So we're going to have to see through that. And we have political strategists that are helping to understand those risks and we're thinking about it. But if you just take a step back and just look at tariffs and recognize that those IEEPA tariffs are part of a bigger tariff package. And there are a number of other tariffs with all these number codes that I always get confused in my head. But there's enough of those other ones where I think substantially, the bulk of the tariffs I think still remain in place. Or if IEEPA tariffs are deemed non-constitutional, they can find other things to try to make up the difference. But all that aside, I think tariffs, they're a revenue source. That's the question.
It's hard to give that up for any government company, whatever. They don't want to give that up.
And if you partner that with a wider tax policy, so if you use tariff revenue to sponsor or at least fund individual tax cuts or corporate tax cuts, however you want to come up with your policy mix, that again is all part of that fiscal impulse that you see really hitting next year. And again, at the end of the day, if the U.S. economy is still reasonably healthy on its own, and then you add on top of that additional fiscal stimulus, and if you get on top of that some extra cuts from the Federal Reserve, then that inflationary story is something that you still have to be very mindful of. So again, in the funds that we manage, we still have protection against or inflation-protected government debt. We still have a gold allocation. All of these are really important to protect the portfolios against the risk of inflation really eroding returns through time.
Which is sort of the key to everything, isn't it? Yeah. When you're taking a look at that fiscal stimulus, tax cuts, other things too, the deregulation story is obviously there in the U.S. How does Canada compete? I mean, this was one of the big things to address, the corporate tax structure.
Yeah, absolutely. I mean, for companies that have the option of choosing one country or another, they're motivated in part by tax differentials. There's a whole host of other things that they want to be motivated by as well in terms of pools of labor and the rest. But I think, this is probably beyond sort of my expertise, but I would try to think at least notionally that Canada as a small market, we shouldn't try to compete with the US on every issue or on every industry. So I think finding ways to specialize and figuring out what we do best, and obviously we have a lot of natural resources that are something that we can work towards understanding and using as part of our economic makeup. So I think playing to our strengths, understanding where we can add value and not try to compete in every market. And I think that is something where that specialization can certainly benefit not just Canada's economy, but you could see it reflected in Canada's market as well.
Finding new people to sell to, clients, customers around the world for all kinds of things that Canada can sell and play to its own strengths. Do you see in this a pivot to Asia? I mean, this is much talked about for lots of different policy in the US and Canada, but do you follow that line? Are there interesting opportunities within that?
I think there's pivots to Asia, there's pivots to Europe. Again, that was one of the questions that I asked when I was overseas last week, is just getting a sense of willingness to sort of partner with Canada and
not just Eurovision, like other stuff too.
Exactly, yeah. And there is something. I mean, obviously you're constrained by geography and infrastructure and logistics. It's much harder to get stuff across an ocean relative to just across a land border. So, there are things that will need to be done that help to improve the infrastructure in terms of Canada's port infrastructure, rail infrastructure, to try to diversify trade. And these are not just things that you will solve in the next quarter or two. These are multi-year type of projects. But as a going theme, and as we as investors know and love diversification, so we as an economy should know and love diversification as well. So finding opportunities to export into these other markets is really important. And you start with trade agreements, and then you work through the logistics of making it happen. And it won't be, we won't fully be able to divorce ourselves from the United States. That's just logistically impossible. But the sense where you get positive growth on the margin, again, it's all on the margin, but that can help at least not only an economy, but a market too.
And are Canada's companies that you speak to the leadership within these companies, lots of people in Fidelity do, they're ready and excited about selling elsewhere and ready to do the ramp up with perhaps stimulus from the government or help from the government and the catalyst discussion, like they're ready for this?
Yeah, I think any corporate leader wants to see a customer, and a good customer is even better than any customer. So looking for those opportunities and having the assistance in the direction of the country from a policy perspective should be welcomed pretty enthusiastically by all Canadians.
What would be a final message for investors navigating through this and the way that you're managing? I mean, there's so many funds, actually can't count them there that you oversee, but how would you kind of tie things up in a bow?
Yeah, I mean, I think at the end of the day, I probably said this at the end of every webcast, but just maintaining that degree of diversification.
Okay.
That's something that's very core to our process. We want to identify the themes that are very compelling, but try to see the themes in the wider context. So I think that's another way to express diversification, is to really put things into as large of a basket as you possibly can. So to understand AI is compelling and potentially transformational technology, but you can't get necessarily AI without US dollars, for example. Mm-hmm. So having ways to just understand each of these exposures and giving an investor a holistic experience is what we're trying to do every day.
Yeah, we're counting on you to give us that broader context. David Tulk, thank you for joining us here today.
My pleasure, thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.